Hey, what's going on, Cashflow Hackers? It's Chris with Life 180. I got my buddy Danny here. We are on video 3 of our life insurance. I'm going to call this a masterclass at this point in time. It is like a deep dive.
Like
we went through term insurance, whole life insurance, and today we are talking all things UL. We're going through UL, IUL, GUL, SUL, SGUL, SIUL, like everything. Hybrid UL. Like we got all these things going on. We're going to cover it all. Danny is a wealth of knowledge in this space. He's before he joined us, he was doing a lot of IUL stuff, and he still does a lot of IUL stuff. But he's probably the only IUL agent that I know, or agent that sells a lot of IUL that does it in a way that's totally in alignment with my values. And so I think that's why we do so much content together. And why we're working so closely together. And so I think this video, you're going to get a lot of really, really good information, that's a good education, that if you've been looking at anything to do with UL, IUL, anything, you're going to get the answers you need to your questions in this video.
Hey, it's Daniel Ronberg from Nation's First Financial. I'm sitting here with my good friend, Chris Kirkpatrick from
What's up,
Life
man?
180. We're doing a 3-part series on life insurance. We talked about term, we talked about whole life, which ended up being like a whole dissertation, which was awesome. And now we're going to talk about universal life. And this is exciting for me because I use universal life in, the form of helping people with retirement a lot.
Yep.
And we're going to talk about where it serves its place, where it does really well for people, and, what it is and the different types.
Yeah.
So we're just going to dive into that.
I think what's awesome about this, and I'm going to let you take the lead on this.
Okay.
I took the lead on the last one.
Yeah, thank you.
One of the more popular videos that I actually have over the past couple of years is, even though I do a lot of video against products like IUL, just educating people about,
know you for that now.
But one of the videos I did is like some of the ways that IUL can work, and that was a video we did together. Wow. And so this is going to be an interesting video because we talk a lot about how IUL is misrepresented, but today we're going to talk more about the ways it actually works, right?
Yeah.
And we're going to breeze past the ways it doesn't work, and we're going to stay more focused on the better use cases of it.
Yeah, I think that's going to be really beneficial for people to understand that. And so we're going to dive into all that. I think the big thing to start with IUL, and we'll just start with IUL there, is when I use an IUL, I am looking to set up benefits for somebody. Okay, so with these different types of life insurance, excluding term, you have whole life, you can develop a cash value. You can build a cash value and save that in whole life. You can do the same thing in an IUL. You can build a cash value in an IUL. Where IUL, I think, is competitive and where its place is served well for people is when you structure it properly with certain riders that make sure that there's going to be some safety elements in terms of that cash value, but when you're specifically designing it for the benefits. That's where I think IUL can really be important.
Totally.
So there's different phases of life. There's the accumulation phase and the decumulation phase. In the accumulation phase, you're looking to save. We talked about that great framework you laid out of having an emergency fund, having an opportunity fund, and that maturing with you. That is a really important distinction for people watching to know that is not where I'm using IUL. Okay, that's important to note.
Yeah.
Not that I'm, I just don't. I just not where I believe it. And
not tax-free income.
Right, and not tax-free retirement
which is the number one way it's sold
Which
online.
is the number one way it's sold, right? Because it looks amazing on an illustration. When you over-illustrate it and build it a certain way, it can look incredible. But that's what's important is like you don't want to be sold on illustrations, right? When you're looking at life insurance and where to put it in place, you want to look at what does each type do really well and what needs do you have? What do you need to accomplish? What's missing from your retirement? IUL can be a great way to have a death benefit. It can be a great way to have a living benefit. And I primarily use it for the living benefit. I think a lot of people are concerned about long-term care. A lot of people have been through a situation now, either with a family member or friend, where they've seen it wipe them out. And they've seen what it's done to the family in terms of stress. And IUL, through that living benefit rider you can attach to it, can accelerate portions of that death benefit to you while you're alive, and it can fill certain holes to help you bridge needs in retirement. That's what it does well, in my view of using it.
Agreed.
Now, I will go one step further and say I actually do use it to develop a cash value, but only when you're age 60 and up. So I will MEC policies that are IULs. Okay, so a MEC is a tax status for your life insurance. It means that you've put too much premium in relation to the death benefit, and the loans will no longer be tax-free loans. And so the reason why that's important for some people, and this is also important to break down too, we're going to just do a little sliver on MECs real quick because I love these.
Sure, I love it.
Okay, so everybody knows that's watched your channel or other people's channels on life insurance that MEC can be a bad thing.
Sure.
That's how I think most people would associate it as something that went wrong.
Most people try to avoid MEC
They try to avoid MEC.
they're in a different scenario, but there are situations. Actually, this is what I was talking about. The video we talked about MEC. So talk about it though, because it's really important.
Yeah, I think it's really important when you're thinking about the context of life insurance to break it down in the phases of life you're in, right?
Yeah.
A MEC is not for the accumulation phase, generally speaking.
Right.
You can use it in that phase. I'm not saying never, but generally speaking, just to keep it simple for people to understand, well, where does a MEC fit in and why would you MEC a policy? I'm talking about age 60 and up. Now, you still may be in the accumulation phase in age 60, but MECs have certain rules around the amount of money that's in the policy, around the interest in the policy, around the withdrawals in the policy. If you're 59 and a half or under, you're going to get a 10% penalty on the interest of a MEC. That's why I'm focusing on 60 and up. But I'm also trying to look more into that decumulation phase, right? So in the decumulation phase, your risks, your priorities, the things you care about are different than in the accumulation phase. When you're in your 40s, you're not really thinking about long-term care as much, more than likely. When you're in your 70s, long-term care is a very palpable fear.
Totally.
People are very concerned about how they're going to live the rest of their life when you start getting into your late 60s, 70s, 80s, right? And when you're in your 80s, if you don't have a plan, it really becomes a serious source of anxiety for a lot of seniors. You know, there's a 70% chance if you're a married couple, one of you is going to need long-term care. And it's a high probability. So that's a really big risk. And long-term care is a very scary risk to plan for in retirement because it's challenging. You got to have income that you've saved up enough money to produce for like 30 years, and then you have the biggest expenses you've ever incurred in your life.
Crazy.
All at once. It's hard. It's a very challenging plan to meet. You know, my personal story with my grandmother, she ended up being a rare case for long-term care. She needed 8 years of skilled nursing.
Wow.
She went through $1 million.
That's crazy.
So even though they were prepared, it wiped out a lot of that money that they had built for my parents, my aunts and uncles, for their inheritance, right? So, you know, seeing my family go through that firsthand, long-term care is very close to my heart. And so the reason why a MEC is really valuable, and an IUL particularly can be, and again, I do MEC whole life. Okay, you can use either one, but the key to a MEC is you're going to say, okay, you know what? If you have funds in retirement and you have a emergency fund, a sleep well at night fund, an abundance fund, whatever you want to call it, right? Enough money to be able to handle anything you could really need to write a check for. That is going to fall into what I call active liquidity. Checking account, savings account for emergencies, anything that can come up. That's going to be money that you need to keep safe, you need to keep liquid, but it's probably going to be more active. Passive liquidity occurs when you save above that. So people get really good at saving into that threshold, and then they even save a little bit above that, and then they go, well, hey, you know, I still want to keep this money safe, I still want to keep it liquid, but I don't really know what to do with it. I'm not really getting that much value for it at this point. That is a great source of money for a modified endowment contract with a whole life or IUL. And the reason why I like IUL is sometimes in that scenario, for me, I've seen it have some really robust ways you can apply it to neutralize key retirement risks like long-term care. You can also use it because it has a death benefit for income replacement. So a lot of husbands and wives, you know, or spouses will look at their income scenario and they go, okay, you know what? We have a good scenario while we're married and alive. We have a terrible reduction of standard of living if one of us passes. What do? Do you buy life insurance? Do you pay an annual or monthly premium on it? It actually takes away from cash flow? Or could you MEC a policy with some other asset class and build in a pretty substantial amount of income replacement through the form of that death benefit? You can do the same thing for long-term care. You can do the same thing for legacy. So if you have that need to try to leave something for the family, you know, another great place is more and more people are learning about reverse mortgage strategies. They're learning about ways to optimize cash flow, use home equity wisely. But there's a kind of a tug of war between, hey, that was going to be the inheritance for the kids. Now you can look at, you know, an IUL maybe with some type of benefit that's put in place to have either a level or increasing death benefit that's going to be able to provide some form of legacy for the kids in that specific scenario. Now, I want to add that whenever I make a policy for retirement and I use an IUL, I'm definitely putting on some type of rider that's going to be either return of premium or that's going to be waiver of surrender. That's very important to me, Chris, because again, when it goes back to the original need and you say, hey, I have this money, I want to keep it safe, I want to keep it liquid, right? The IUL has upside potential. So the way the IUL gets credited its interest is it's going to look at an underlying index, you know, and give credits up to the performance of that index, depending on how it does. When the index goes down, they're going to make sure that you don't have any loss directly correlated to that index going down. However, there's still fees. And so when those fees hit, you can actually have a balance that goes down.
Sure.
Return of premium is very important because that rider says, hey, you know what? Whatever happens with this performance, you want all your money back, you can take it back.
But the good news, I want to say this too, because you've mech'd the policy, the corridor, the net amount at risk in the policy is always way less than it would be in a non-mech policy for an IUL. Right. So when you're doing that, the cost of insurance is going to be much less because the annual renewable term in relation as far as what is actually at risk is going to be less.
I'm so glad you said that. I wouldn't have thought of this until you brought it up, but it's such a great applicable example. I have helped people and seen many IULs that were mech'd with the return of premium rider, and people had these things even into their 80s and still having cash value growth in the policy, which is unreal. Now, what's interesting about that, though, is you would never max fund an IUL for somebody in their 70s or 80s for cash value growth. That would be insane.
Sure.
Right? But when you mech this type of policy, you actually end up, it's totally different. It changes the rules. So that's why mech deserves a seat at the table. That's why I've been talking about it so much. It's such a powerful tool. Like, to even have a life insurance vehicle that is in the IUL family, growing for someone in their 80s, the cost of insurance is so high because you're so much closer to mortality. But the indexing is so powerful, and when the corridor is so narrow, and you have that safety net of that return of premium.
I was going to say that's the return of premium safety net is the saving grace. And the other element of that is, and correct me if I'm wrong, because but the other element of that is you have that return of premium. And you have the money growing, but you're not leveraging this money for tax-free income. Like, that's not the purpose. Now, if people need it for emergency, it's there. How does it impact the return of premium if you take a loan against it?
Well, that's another good point. While you can take a loan from your mech, remember, these people, going back to the framework, right? That's why we're trying to build these. They took that money from a place where they said, hey, this is kind of like in a savings account. This is kind of like in a
money
CD.
You don't need.
Yeah, it's money you don't need. And they're not using it for loans, right? If they want the money back, I call it all or nothing liquidity. We're not going to take loans from the mech. You're either going to cash it out or you're going to keep it.
I just wanted to be really clear. I knew the answer to that. I thought it was, so I just wanted to be really clear. Just full trend, I've never sold one of these, right? I've talked to Daniel, like he has.
I've happened to think they're pretty incredible for the right circumstance, and so being in the field, meeting with clients, helping people with these, I've been very proud of these over the years. Because they do have when you mech that policy, and you have that indexing as high as it is, you can actually have a pretty cool scenario in that specific phase of life. And what I love about them, Chris, is, I mean, it's where else are you going to have an opportunity to get somebody in their 70s or 80s a meaningful benefit to care for them for the rest of their life? That's what it comes back to. It doesn't matter about indexing, dividends.
For sure.
What it matters is, like, you're sitting down with somebody and you have a chance to provide them with dignity, security, peace of mind, honor their legacy, protect someone's grandmother. That's what it comes down to.
That's what I always say. It's not, is the product good or bad? Is it in alignment with what you need it to accomplish? And that's the only reason I don't like IUL typically is because it's not because it's a bad product. You just used a good use case or explained a good use case of it. The problem with IUL is for the tax-free income retirement, right? The misrepresentation of how that works online. That's my problem with it. Like, so I'm going to tell you something. I don't even know if you know this yet.
Okay.
Ready?
Now I'm excited. But remind me, I have one thing I want to say.
Okay, well, no, you say it first. You say it first.
You're not going to forget yours?
I won't forget mine. I can't forget this one.
We did in our last whole life video, we said, hey, if you are on TikTok or Instagram or whatever, and you see some corny, hey, this is how you're going to get wealthy video with life insurance, skip it. I'm going to say something else that I want to know if you think is true. If you get presented an illustration where loans are coming out for retirement income, skip it.
Don't take it with any level. I would say don't skip it. Send it to me so I can do a reaction video.
Okay. Is there like a general mailbox people can forward illustrations?
I need to create that. Like Chris reacts at.
You know what you need? You need an up, like somewhere someone can just upload an illustration.
Like, yes, that's a good call. I mean? Yeah, I should figure that out.
Yeah.
All right, you ready?
Yeah. CompareMyIUL.com.
I have RescueMyIUL.com.
Do you really?
Yeah, and people go there all the time and submit Rescue My IUL. People go and they submit their original illustration, the in-force illustration, and we do a full evaluation for free. Anybody that wants it.
Rescue My IUL.
Yeah, just to consult with them and help them realize the best path forward for their IUL.
Wow.
whether it's 1035, whether it's surrender, whether it's you're close enough in the surrender period to keep going for a couple of years to let the surrender go down and like figure it out. We kind of give the coaching on the best way to go.
That's cool.
All right, you ready for my fun, exciting?
Yeah, sneak peek.
We're now selling IUL.
What?
So here's the deal.
What do you mean?
I always tell people I'm open-minded.
Yeah.
I don't think people believe me most of the time.
Okay.
Especially the IUL people of the world.
Yeah.
But we're now selling IUL because there are certain IULs that we've found and we've now gotten a contract with. I'm not going to name the company right now just because of a lot of reasons that you know of as far as compliance and all that stuff goes. But the IUL, it's not going to be sold for tax-free income, obviously, because that I would never do.
Right.
I figured but there are IULs that have guaranteed riders associated with them, and you're going to get into the GUL and the SGUL and all that stuff.
Well, even IUL with a strong guarantee.
An IUL with a strong guarantee and guaranteed riders, like so. I just did a case study going through illustrations, and I looked at IUL illustrations not through the lens of the potential upside and the indexing and all that, but through the lens of what are the guaranteed riders associated with this and what would be the actual guaranteed result of this policy.
Yeah.
And what we found was we could where IUL outshined whole life is if you utilize it and you utilize the annual renewable term chassis. There's one company that I found that you can basically say, I want to have guaranteed until a guaranteed IUL insured up until age 85 or up until 95 or up until 100 or 105. Like you can pick it and it changes the price. You can literally dial it in.
That's cool. To
a specific year. You could say until I'm 93 years old, I want to have this coverage in place.
It's amazing.
And you could do that and guarantee it. And so it's not so different than like a GUL that you'll talk about.
Yeah.
But it's just a bit more flexible.
Yeah.
And it's going to have a little bit more liquidity.
Yeah.
But once again, as soon as you start tapping into the liquidity, the guarantees kind of go out the window.
Right.
Right. And so it's a give and take. And so for the right person from a legacy planning perspective, it's kind of like a perma term.
I like that.
Right.
Yeah.
That's
how I think of GUL.
Right. It's perma term.
Perma term.
And a lot of cases, GUL is still going to outshine. It's going to be cheaper than this because this is a little bit more expensive.
Yeah.
But for the right person in the right scenario, it's a good fit.
It's amazing. So that brings me to a good point. I want to break down, going back to people who are watching this who want help to, because the whole mission for us to create this video was we want to create clarity.
Yeah.
You know, we want to help people to really understand where you use these types of products.
Yeah.
Term is going to be, a very economical way to serve you from protecting from financial risks. You're going to be able to just get cheap term. You can rent for a term. It's going to cover that risk for a certain period of time, and you're going to move on. Yeah. Whole life is going to be something that we use as foundational. That's going to be in the accumulation phase. When we move into the decumulation phase, that's where we're going to start looking at modified endowment contracts, universal life, guaranteed universal life, and survivorship universal life, which I'm fired up about. That's where I get excited about SGUL. So index universal life, right? You're going to get more. You're going to have the upside potential. You're going to have some flexible riders and benefits you can put on. But I think what you said, Chris, is so important to look at these riders. We did a really good job, and I loved what we did with the term video on the riders. Riders are important. They matter when you look at policies, right? And a lot of agents don't even know all the riders that come with the policies they're selling. Like,
totally.
And then I've met into a lot of people who are like, I didn't know that was an option during my application. Like, why didn't we check that box and get that rider,
That's so, and I want to say this before I forget, because the riders are key. And I'll say this. The riders are an area where IUL is better than whole life in a lot of scenarios. Not to say that whole life doesn't have riders that are powerful that you can utilize.
Yeah.
But that's one of the benefits of the IUL chassis is some of the flexibility in the different riders. I'll tell you what, across the board, there's better long-term care riders on IUL. If you want pure long-term care, not just living benefits,
I would agree with
IULs have better long-term care riders. There's one
outside of the hybrids for whole life,
right?
Because the hybrids for whole life have some pretty robust
bingo,
riders.
bingo, yeah, exactly.
Like,
but that said, like I'm just trying to be totally like
no, that's very objective,
even keel objective as possible.
Yeah.
Is that the long-term care riders across the board for IUL are tend to be have more options. We'll say
a lot of options.
Right? A lot
early
of
high
options.
cash value. I mean, you can do some cool stuff. Like especially when you get into like the business world, like you can do early high cash value. I mean, there's all kinds of cool riders you can put in place.
The challenge with IUL is that a lot of the riders are only as good as the policy being enforced, and you have to read the fine print. And my challenge is a lot of times people sell it for all these riders and they're like, oh, you have this rider and this rider and this rider and this rider. And then they're like, no lapse guarantee, all these things. And then they go, oh, and then you use it for tax-free income and retirement, which is where the wheels always fall off. And if you read the illustration, typically most of the riders, and read through the illustration before you sign on the dotted line, most of the riders, you'll see they get voided as soon as you take a policy loan. So they offer all of them.
Yeah.
But then as soon as you start doing the tax-free income retirement strategy, a lot of the other riders that you thought were there for you are gone.
Yeah. I'll just say this on the tax-free income for retirement, because I think this is like the biggest reason I got into YouTube, Chris, if I'm being honest, was like, it's hard to help somebody realize what this would feel like. But I'm very concerned about people putting the majority of their income hopes into IUL for retirement, because the scary part to me is it'll work for a period of time, but you don't know when it's going to stop working, and that person's going to be all by themselves in their 70s. That's what scares me the most. Like if you just think about this for a second, okay, let's talk about it. You want to talk about a case study? Let's say you have someone who, and I've met people like this, that some agents come along and convince them that you want to put 100% of your retirement income into IUL, okay? And they're not there helping them reallocate it. They're not there helping them with the death benefit changes that have to occur. They're not running in-force illustrations, multiple in-force illustrations, multiple times a year to check on how.
Yeah, at least once a year.
To service an IUL, that if you're max funding an IUL in the accumulation phase, to service it properly, you have to be running in-force illustrations all the time.
Yeah.
Like
especially because they're point to point.
Work.
I don't know if you guys realize this, but when you buy these index ULs, like what happens is the most index strategies are point to point annually. So every month you have a new segment of the IUL. Yeah. And so every month, technically speaking, you should need a new in-force illustration to deal with the new market segmentation.
And when your premiums go in, they will segment when your so you can have
it's messed up.
You can have multiple premiums on different allocation schedules, and then you might miss a reallocation for a portion of your premium you don't even know. And so that's why it's so important to do that. But again, the thing that scares me the most about it is if you're in your 70s and you're by yourself, your agent's not servicing the policy, and you just don't know when that cliff's coming. And when you're approaching the cliff, it's already too late. Because that thing will fall apart so fast. And it's scary because you have the annual renewable term that's increasing. You're taking massive loans, which puts pressure on the policy to perform. You hit a couple years of zero, you got some serious risk. And that's the thing I think that's our mission, is like, that's what scares us most, is like, IUL can be used properly. It can have a place. We just talked about it, right? You're using it in some places. I'm using it in some places. It has too much risk in that space. It's just because you can lose all your money.
Totally.
And anything you can lose all your money in, to me, is just too risky. I don't want to, that's just
100%
too
agree.
much. So,
and this is my problem with people like Doug Andrew. Sorry,
you're just calling out everybody on these videos.
I don't care. That's what I do, man. You don't get on video with me if you don't expect me to call people out. Sorry. But like that's my problem with people, is he's the guy who's going to tell you to take everything that you have and put it into an IUL. You know?
I've seen his videos online. I've never met him.
There's a reason he's no longer licensed. There's a reason. If you look, just Google Doug Andrew lawsuit. He's the #1 IUL trainer in the world.
Wow.
In the world. Google Doug Andrew lawsuit.
Who was the laser fund?
That's Doug Andrew.
Oh, that's Doug Andrew?
Yeah.
Okay.
He's a clown.
I had anyway, I'll tell you that story later. Anyway, IUL, like, let's break it down, right? There's use cases for it. I think going back to what phase of life you're in, what you need to have happen, can it remove risk? Is it set up properly? Do you fully understand it? I think that's important to take a look at. It does have a place, and MECs have a good place in there. We touched on hybrids, which is kind of interesting because it can be in the MEC category, but.
Can I pause you for a sec?
Please, yeah.
Define to everybody, because I don't think we did this at the very beginning.
Okay.
Define to everybody the history of it, or I'll do the history for real quick. In the early 80s, Universal Life was created by E.F. Hutton. That went, and then they had like VULs. There was Guaranteed Universal Life, and then IUL came out, Index Universal Life. IULs kind of started dominating the market, and like just the marketing, TikTok, Instagram,
Yeah.
You know, 1 minute, microwave mindset culture has allowed that to kind of take off. But the UL platform
Yeah.
is the foundation of all of them.
Yes.
Explain what a UL chassis is.
So a UL chassis, and this is interesting because all my mentors they were in the industry and lived through the whole UL thing. And so the UL chassis is basically an annual renewable term chassis where you can overfund and put a cash value. And it's going to be based on the old ULs where the company would just declare an interest rate. The problem with ULs were, and this is what all my mentors went through in the 80s and 90s, were, you came from the whole life, which was around, everybody knew it, they knew how to sell it, they knew how to offer it, they knew how to structure it. ULs came out in a higher interest rate environment. All of a sudden, you could illustrate these things to look incredible. You could put way less premiums in, and that interest rate would carry the policy. When you're working with an interest rate of 12%, Chris.
Yeah, it's amazing.
You put it next to a whole life, you can go to all your old whole life clients and go, wait a minute, why would we keep doing this? But again, that's the difference. It's not guaranteed.
Right.
And so, what they're saying is, hey, we can start saving money on your insurance. Let's put in less money. Plus, they pay very, very well. So a lot of agents moved over and got into the whole UL game. And what happened was they, found out years later that they were doing them in a high interest rate environment. As interest rates tapered for 30 years, these things started to blow up. And what we mean by blow up is lapse, meaning that, hey, it worked on a 12% interest rate. When the interest rate actually turned out to be like 4%, it didn't last. One thing that's really important that a lot of people don't know is if you look at your universal life statement, it'll say right on there,
with the
current assumption and guaranteed assumption with current premiums and without current premiums. And a lot of people are shocked because they don't know what that really means without someone explaining to them. When you look at your current assumption with current premiums, if it's on track to lapse, you got to get out in front of that and make a change if that's not suitable for you.
For sure. And a lot of times it's too late.
A lot of times it is too late. Yeah.
Or unless you are super liquid and can come out of
because the thing about a UL that's interesting that people don't realize is they'll go, oh, I'll just pay more premium. They don't realize that annual renewable term has been it gets massive. Think about a term policy. This is how it works. Think about your term policy when it hits the end of the term. People always go, oh, the premiums jump up. It's crazy.
Yeah, it
it's
ends up being $20,000, $30,000 a year just for
force you out.
Insurance costs.
That same thing is happening inside of universal life. And so, that's what scares me about these people that are putting a lot of money in is you get into your older ages, you won't be able to fix it, catch up. So again, it's good in some places. You got to be careful of it in other places.
For sure.
You really got to know what you're getting into. So that's index universal life. And I want to go to hybrids for a second.
I love it.
I don't think hybrids could be their own type of video.
Yeah.
But a hybrid
we just did a hybrid video, didn't we?
Well, we did
a couple months ago.
We did a couple months ago, so we won't go into the whole thing.
Okay.
But at its core, where you would use a hybrid is, again, in the form of trying to solve another retirement risk. I think the best, really the hybrid that I use the most is and really the main one is just for long-term care. You can go out and get a combination of a whole life and long-term care policy put together. The reason why that's super important is a lot of people don't do long-term care planning because they don't want expensive premiums. They don't want premiums that could go up. They don't want the threat of the company writing to them saying, hey, you know what? You have to put in more money. That's a scary proposition with long-term care. They don't like the fact that they might never use it. So that's a big problem with long-term care planning. That's why people typically avoid long-term care insurance, is those 4 reasons. Hybrids solve that because it's built on a whole life chassis. We've used this word chassis a few times. It comes with a guarantee on the whole life side, which means that your premiums are guaranteed, the performance is guaranteed, the death benefit is guaranteed, and the care benefit is guaranteed. That's very important to me because as an agent, I don't want to ever be in a situation with a client where they come to me in 15 years and go, hey, Daniel, what's this notice from the company?
Can we talk about that for a second?
Yeah.
So you talked about whole life, all the guarantees behind it. And then you could do UL or IUL or whatever.
You could put a rider on.
You could put a rider on for those. That would be similar.
Yeah.
But a lot of times they're going to be cheaper. And that's how the agent sells you. They go, oh, look, it's cheaper, it's upside. It sounds a lot like your UL story from the 80s, right? Yep. But the thing that I really encourage people to do is just use a little common sense. Okay. Because in what world are you able to offer a better benefit for a cheaper price, right? And still protect yourself the same way. These companies are actuarially driven. There's no free lunches in insurance.
No, they know exactly.
They know what they're doing.
Yeah.
if they're giving it to you at a cheaper price, my guess is there's a significant amount of risk that comes to you. So when I explain,
the pressure's on you to perform
exactly
to keep that cheaper price.
Right.
They're not
And
gonna,
if the risk, like with a whole life policy with a long-term care rider, the risk is on the insurance company to meet the obligations. They're taking that risk on. If markets underperform, if the general fund underperforms, if all these things, they're going to make sure you're made whole.
Right.
Right. In a UL, if anything goes wrong, it's on you
on you.
to make up for
Yeah.
it. So they've offset the risk from them to you, the policyholder. That's the biggest difference.
Yeah.
And actuarially, they can price it cheaper because they don't care.
Right.
I mean, not obvious. They're not heartless, but they have no financial risk at all.
Right.
So they don't care. They can. It's now just a sales war. It's an illustration war about what do we sell.
And that's why I'm so passionate about this, Chris, is like when it comes to retirement, when it comes to long-term care, protecting your spouse, making sure you have enough income to live, you don't want risk.
Totally.
You need that to be there.
That's the time of your life when you want zero risk.
If you have long-term care benefits in place and you're trying to rely on those, you don't want those to fall apart on you.
Totally.
That's the biggest thing.
Could not agree more.
And that's so important. And going back to this too, like when you think about, and I've been in the situation where you have kids come in for mom or dad who can no longer take care of themselves or power of attorney, they're not going to care if you mech'd IUL or they're going to care that mom and dad are okay. That's the most important thing. And that's what they care about. But when it comes to hybrids, there's hybrid annuities, which that's a whole other video, but those
Actually,
are
I think that's the one we did.
Yeah, we did hybrid index annuities, which are
those
really
are great.
cool. Those have amazing long-term care benefits with them, and those are where we use indexing in the form of an annuity with a long-term care benefit.
Yeah.
But on the life insurance side, when we're talking hybrids, we're talking whole life that's going to have a true long-term care benefit and actually has different underwriting for morbidity, for long-term care criteria, that's going to have a very robust rider. So think of the mech where you can keep a lot of money safe, you can keep it relatively liquid, and then you're going to have a much better long-term care benefit rider in comparison to the death benefit you get.
Do you ever combine long-term care benefit riders with mech policies? Can you keep the tax-free nature of the rider if it's a mech policy?
You can keep the tax-free nature of the rider. So mechs are interesting. They're going to be taxed like an annuity while you're alive for the cash value.
But the death benefit.
But the death benefit and accelerated death benefits are going to be tax-free. So yes,
so
we do that.
that's a huge.
That's a cool
huge
spot.
one.
Yeah, you can add that rider on. So again, that's where you're going to be, but it's benefit driven. It's focused
because it's
on
rider driven. It's benefit.
rider driven.
It's not the cash value.
Yes, you're going to focus on removing key risks. That's what's most important.
Yeah.
So carrying on to that, let's talk about GUL because I love GUL.
I love it.
And so I think GUL is a very powerful tool. It very much so is for my family. When we sat down with my mom and dad's retirement, and we said, what are you missing? What's your hole? Where's this gonna go off the rails? What we noticed was there's a pretty big age difference between my dad and my mom, and we noticed that hey, there's a lot of income on dad. Mom's got a long way to go. Like, what are we missing here? Should we buy more income and try to do joint lifetime income for dad and mom? Like, what's going to be the most economical way to solve my parents' problem? Get more and more GUL on my dad. That's what we ended up doing because GUL is going to be something like you mentioned with the permaterm, like what you guys are doing with the IUL now.
Yeah.
It just has a super strong guarantee. That's what the G stands for. It's guaranteed universal life.
Yeah.
Okay. So what that means is you pay this premium on time. You can pick the age with the company that you want the guarantee to.
It's amazing.
You can say, I want to be guaranteed at 95, 100, 120, maturity, whatever it is with that company. And you can actually literally just say, I want to pay this amount for this premium. What gets exciting about GUL, and I'm going to move to SGUL, is the leverage. You can do things that are really, really powerful using the company's guarantee for you. And it's a great way to map out predictable results, just like you were talking about earlier in the whole life video. You can just say, hey, you know what? We need mom to have this much money to replace the income when dad passes. Let's go ahead. We'll make a commitment of this premium. That's going to happen. Now my dad can feel rest assured. My mom can be okay. We can feel okay. Knowing mom's going to be cared for no matter what happens with dad. And that will happen. So that's what's really special about GUL is you can literally just get a pretty economical premium in relation to a good amount of leverage. And I wrote my first book, No Stone Left Unturned. That's what it was all about. At that point, I had met with, I think at that point, about 1,000 families. And I realized everybody had most people had their net worth concentrated in a 401k and a home. Yeah. And if they needed long-term care, it was a big problem. So we were able to say, hey, you know what if we could dedicate a portion of that interest of some of your retirement savings to a GUL with a strong living benefit rider or even a long-term care rider? And that would be a bucket of money that would basically take your retirement savings and elevate it. It's like access to instant estate through that rider that's going to distribute tax-free so you can have the return of your wealth to you very, very efficiently. and without interrupting other things for your spouse. So
That's
having that leverage is really important. Now, what you can do with GUL is you can make it SGUL. This is the last type we're going to cover. That's survivorship. And to me, it's really exciting. Now, survivorship is cool because they're insuring 2 lives.
It's like second to die.
Second to die. Yeah, you can also do first to die. You can do joint life. But survivorship is going to be second to die. And people go, what is that used for? Why would you want a policy where 2 people have to die to get the benefit? Because you get way more leverage. So this is really powerful in the legacy bucket. And it's even powerful. We did a cool video on the cash flow bucket. I think you could create a form of cash flow hacking using SGUL. So SGUL is the same as GUL. You pay a premium, guaranteed to a certain age for both people. The leverage is ridiculous.
It's amazing.
And especially where it's really shines, Chris, is in senior ages. Ages 60, 70. You'd be surprised. People go, 70-year-olds don't buy life insurance. 70-year-olds and 60-year-olds buy the most
more life insurance than anybody.
It's crazy. People don't know that. They think it's so expensive because they're just looking at term. They're saying, oh, that term cost must be exorbitant. But it's like, hey, when you can give yourself that guaranteed result, it's hard to compete against that.
And I want to touch on that really quick because, we in the last video, we talked about how whole life will grow with you and all these things, right? And so what you just said, 70-year-olds and 65-year-olds buy the most life insurance. They get there and they're like, oh, crap, I've made a mistake. I wish I had done this early. How many conversations do you have with people like, I wish I had done this 20 years ago?
That's the number one thing I hear from people I meet with is I wish I had met you earlier and I wish we had started this 20 years earlier.
I kind of explain to people is my job is to not sell anybody anything. It's to bring people through what I call the 4 levels of awareness, right?
Ooh.
Are you familiar with this?
No, I'm not.
So the 4 levels of awareness, I learned this from a sales trainer back in the day.
Okay.
Is when I meet with people and when you meet with people, typically they're unconsciously incompetent. They don't know what they don't know, right? So our first job isn't to sell anybody anything. It's to make people consciously incompetent, bring them to level 2, meaning they know they have a problem even though they don't understand it fully. So they went from I don't know what I don't know to oh, I know this thing exists and I know I don't know much about it.
Wow.
Right?
Yeah.
And so then from there, that's level 2. Level 3 is you become consciously competent. I learn about it. I sit down with Danny. I go through this education process. I realize this. I have that epiphany moment being like, I wish I'd heard this 20 years ago. And that's it. And then stage 4 is unconsciously competent, meaning you're like me and Danny, you know this stuff inside out. Like it takes 10,000 hours. It's a Malcolm Gladwell 10,000 hours of work to get there. But like that's what we're doing. We're bringing people, like when you meet with people and you're doing that, it's like they're unconsciously incompetent. They don't know what they don't know. And so when we talk about like the fact that these things grow with you, with whole life and with even with these other policies, like the younger you start, the better off you're going to be, as long as it's in alignment with the expectations of what it's supposed to do for you later in life, and as it grows, and make sure you understand all the variables. You mentioned one other thing I wanted to, I don't want to let it slip by.
Please, go ahead.
You talked about how the SGUL offers a lot of leverage.
Yes.
Okay. Tom Wall wrote a book called Permission to Spend.
I love that book.
Right?
Yep.
Amazing book.
Yeah.
Talk to me. I want to hear how you describe this.
Okay.
Talk to me about how having this SGUL from a legacy perspective, if that's important to you, gives you permission to spend, gives you that opportunity.
Thank you. I'm
to
so
handle
glad.
the rest
This
of it.
is where I was going to go.
I know.
This.
That's why I'm.
Okay. Thanks for teeing me up. So, SGUL is a way for people to eliminate some of the tug of war and actually a form of scarcity that occurs in retirement.
100%.
So when you get into retirement, you have a big responsibility on a bucket of your money or the portfolio to do a lot of different things. It's got to generate income. It's got to weather economic crises. It's got to handle interest rates going up or down, volatility. It's got to provide long-term care. It's got to be your charitable bucket. It has a lot of jobs to do, and you're not putting any more money into it. That's why everybody's so worried about it.
Yeah.
One of the biggest concerns for people is a lot of people say, I want to leave my kids better off than I was. I want to leave them something. Now, not everybody cares about that. It's not a priority for everyone, but a lot of people go, this is special for me. I want to leave them this. And that creates some scarcity and a tug of war, because now you go, well, we want to fully enjoy our lives, but we also want to leave us money for the kids.
Sure.
Right? And we touched on that in the MEC video we did, a year ago or so, where the leverage gives you permission to spend is you can literally go to a company and say, okay, we want our kid, we want to be intentional about this. We talked about intentionality, right?
Yeah, I love it.
We want to go ahead and say, we want the kids to get $500,000. How are we going to do that? You can say, I want to 10 pay this SGUL, put 10 premiums in.
Boom.
There's the 500,000. The rest becomes yours and gives you permission to spend.
You've created a specific result.
You've created a specific result, and you can do that with GUL and SGUL. Going back to my parents' situation, I was having a conversation with my dad the other day, and I go, Dad, why don't you look at this HECM again? We've talked about this. He goes, Dan, why would I do a HECM? I have a paid-off house. Doesn't make any sense. I go, Dad, think about it. You and Mom could take 2 killer trips every single year during the first 20 years of your retirement.
Yeah.
We could buy a GUL and replace all that money for Mom and do it for pennies on the dollar. And the light bulb, I saw him. He was like, wait, we got, 400 grand for fund money with Mom.
He's like, dang, I raised a smart kid.
I was like, I call dibs on being your agent, by the way.
Yeah,
No,
right.
I'm just kidding. But, it's that
You're
kind
like,
of
just
thinking,
write me
right?
on for 20% of the case.
So, that's where we try to get really intentional with
Yeah.
people. We say, hey, look, you're saving this home equity, but why? Well, it's for my kids. Okay, well, don't you want to make memories while you're kids? Sure.
Yeah.
Why don't we make some memories, and have some fun? And again, it's not all about reverse mortgages. It's just one example of saying, hey, this is where you can do something really cool.
You actually got me thinking
Okay.
about because usually when I hear about the SGUL,
Yeah.
it's couples in their 60s.
Yeah.
Late 50s at the earliest to
Yep.
60s. Have you ever written an SGUL on somebody in their low to mid 40s?
Have you seen them? They're incredible.
I want
will-
you to
I will
do
send you
one
one.
for me and Hannah.
They will blow your mind.
I want you to do one for me and
You
Hannah.
will freak
I want
out
you to help
how
me.
much-
I just started thinking
Yeah.
about it and I'm like,
It's
I don't want to look at it.
it's crazy.
Yeah.
It's so exciting.
I wonder if it's on 2 lives, if that would be a way we could get her covered a little, because it's not only her life.
Oh yeah.
You know what I mean?
And that's a great point, Chris. You can have an uninsurable spouse on an SGUL.
because they can insure the second.
They're still
It'll be
insuring.
something.
They're still covering mortality costs amongst 2 lives, and I've
Yep.
had that where one spouse is uninsurable, but it still makes more
Yep.
sense to do it as an SGUL.
Yep.
SGULs you can build a cash value in,
Yep.
which I think is really cool.
Yep.
I've seen that as a really cool way for people to use whole life in their 60s.
Yep.
And structuring it as an SGUL as a MEC, which is
I'd be fascinated to see.
It
We
is
should
cool.
do an SGUL and then do a video on that.
on the whole life
like the
SGUL.
case study for
Chris,
me at
they're
a 40-something-year-old.
awesome. Yeah, and
So
show the
guys,
difference.
subscribe and hit the bell. That way you see it when we launch
that'd
that
be
video
cool.
too.
Let's do
That'll
that.
be
We'll
awesome.
circle back to that one. We'll
Yeah.
do like a real. Okay, so that'd be cool. But yeah, the SGUL is so powerful. Now where we're seeing a lot when we're using retirement income annuities is the interest rates are so high. The payout factors on these annuities right now are the highest they've ever been in my career. They're sick.
It's insane.
It's insane. So you have somebody in their 70s, Chris. You can get an 8-9% payout factor. Sometimes higher if they're in their 80s. I've seen SPIAs, Chris. We did a SPIA for someone in their 90s. The payout factor was 22%.
You think?
It's crazy.
That's crazy.
It's unbelievable, right?
For 90-something years old.
Yeah.
I mean,
Well, and she had a life insurance policy, an old UL,
Okay.
that the premiums had creeped up to the point where they were
so she was
unsustainable.
gonna lapse.
So we annuitized to protect the premium so it wouldn't
got
run
it.
out.
That's a good idea.
Yeah.
Cool.
Thanks. I have a couple good ones once in a while.
Yeah, that's cool.
So anyway, that protected the legacy that she'd put in and got her guaranteed to maturity. That's the only reason you would ever really
Cool.
do that, So
That's awesome.
But anyway, when you pair the payout factor with the SGUL together, that's where you get some pretty incredible results because now you can say, okay, how much in relation do we want to leave as a basically like the principal amount you're keeping safe, right? How much you want to pass to the next generation, but how much cash flow do you want to develop for you? You can put those 2 products together like 2 puzzle pieces and say, hey, let's get a high cash flow uncorrelated to interest rates or market returns for me and my spouse that's guaranteed for our lives. And then how do we guarantee that we'll be able to leave that money for our kids? Powerful combination.
I'm super curious. I'm like dying with
Let's
curiosity.
go.
To
We got to
see it
get
now.
into computers. So anyway, this concludes our 3-part
Yeah.
series on
No,
the
it's
different
amazing.
frameworks of life insurance. We went from everything from term all the way to SGUL. We covered a little bit on hybrids, MEX, whole life, UL, GUL.
I honestly think these 3 videos back to back are probably going to be the most comprehensive, like really deep dive. Not super technical, but more like real world practical use case. Which unfortunately there's not enough stuff of that out there. And so
No, people need a place they can go check to see what's true and what's not.
Yeah.
Like we didn't sell anything in these videos. We're
No.
not trying to. We want to give people the armor and the knowledge to say, hey, when I'm talking to agents online, what's true? How can I create some boundaries? Say, okay, that sounds right. This is a framework I know is going to serve me and my family. That's the purpose of the series.
it's awesome. Well, guys, if you found value in this, which I think you did, make sure you subscribe, hit the bell, share this video out there with people, whether it's somebody's looking to learn about this stuff, whether it's an agent who's looking to learn, people on your team. This is the deep dive elements beyond the X's and O's that people need to understand, the actual use cases. there's no good products. There's no bad products. It's just, is the product the right or wrong fit for what you're looking to do? And the stuff we covered in these last 3 videos is the stuff that you need to understand to know the answer to, is it the right or wrong product for your goals and objectives, right? And so,
Well said.
yeah, that's what I would say. So hopefully you found value in it. If you did, like I said, subscribe, hit the bell, you'll get notified. And if it's, you've been a subscriber for a long time, we take what we do with a lot of seriousness and a lot of responsibility. And hopefully you're finding this place to be one of the best places on the internet to get this education and content. So if you do, give me a thumbs up in the comments so I know. It just gives me a little awesome feedback. I like some comments every now and then. So until next time, have a blessed, inspirational day. We'll talk soon.